Hello and welcome to BloombergQuint. We have with us a man who needs no introduction, Mr. Rashesh Shah, the Chairman and CEO of Edelweiss Group, to give us a fine print of their earnings. And so first and foremost, thanks for talking to BloombergQuint.
Thank you very much.
And not taking much of your time, my very first question would be, sir, revenues has seen a jump of over 200% in this quarter. What factor is driving the growth?
If you look at our revenue on the same quarter last year, we have clocked about, at a consolidated level, we have clocked about 28% growth in revenue and a 41% growth in profit after tax. And obviously 41 is good, we are happy about it. But what is more interesting is now we have had 24 quarters of consistent growth in profits, and our CAGR over these 24 quarters has been 38%. So I think what we set out in 2012, when we had a plan for the next 10 years, and the idea was to grow profits consistently at about 25%. So we are ahead of that. So what I'm more happy about is not only the 41% for this quarter, but also the fact that over 24 quarters we've been able to clip along well.
What are your plans to scale up retail business, sir?
We are seeing good growth momentum. On the wealth management, we have grown our assets under advice by more than 100% this year. Our retail credit book, which is home loans and SME and all of that, has grown at 58% this year. So we are seeing some fairly big growth numbers on the retail businesses, which is insurance, credit and retail wealth management.
So my very next question was about insurance, since you have touched it. So what are your plans for insurance business in particular going ahead?
So we have currently a very robust insurance business with a partnership with Tokio Marine. It is a life insurance business, and in that over the last 4 years we have done reasonably well. We have grown at more than 35% a year, built a good business. We are also very conscious of cost, because we think insurance on a long-term basis has to be a cost-effective business. We will start a general insurance business for which we have got all the approvals by January next year. So our idea is to offer a good package of general insurance and life insurance products to our customers. So the way Edelweiss is evolving, we have 3 groups of businesses. We have our credit business, which is both corporate credit and retail credit. We have our asset management, wealth management, capital market business, what we call advice and franchise business. And we have insurance business. And now we have a very complete product range. And we have followed a fairly unique model of offering a broad range of services as compared to being just a housing finance company or just a brokerage company or just an asset management company. And we think on a long-term basis, this is harder to do. I must admit that. This is a lot harder to do. But if you can execute well on this, then the rewards are much more, because you have a common customer who is participating in various products and services of yours.
Absolutely, sir. And how will the shift in physical savings into financial savings translate in numbers for Edelweiss?
So in various ways, I think as the physical savings are getting more and more diverted to financial savings, there are a couple of other trends also happening. Even within financial savings, what was going in banks is coming into capital markets, because as you know, bank interest rates are falling, and banks also are flush with so much liquidity that they are not very enthusiastically taking more deposits. So increasingly they are also happy if those funds go into the markets, equity markets, bond market. So for us it helps our broking business, obviously, because more people accessing markets, equity, bond, all of that helps us. We are seeing a lot more flows into mutual funds. So we have a mutual fund asset management business, which has also been growing well, because like all other mutual funds, we are also getting funds. It comes into insurance. So when you have financialization of savings, I call it like rain is falling. It falls on a lot of things. So it's falling in asset management business, it's falling in insurance business, it is falling in a capital markets and broking business, because they're all correlated in that sense. But I think the larger trend is, households are shifting assets away from physical assets to financial assets. But even within financial assets, they're shifting from bank deposits to other financial products like equities, mutual funds, bonds, all of that.
So this, what we are seeing, is it a one-off thing, or you believe that the trend will continue for financial savings?
I think it's a secular trend. It will go through its own cycles. But it is clearly a secular trend, and this secular trend has been over 20 years. Because as our economy is getting more organized, as households have become more conscious, plus interest rates, inflation is down. Now If interest rates go to 10%, it's easy to just keep money in the bank because then you don't have to worry about equity, bonds, all of that. But when interest rates are 3.5%, when State Bank of India gives you 3.5% interest on your savings account, you have to think of alternatives because you need to have slightly higher yield.
We have seen a progress on the distressed asset business as well, and given RBI's focus on cleaning stressed loan in the banks, what is your outlook on the same, sir?
I think we are getting to the phase 2 of the cleanup. The phase 1 of the cleanup was identifying, provisioning, all of that. So if you've seen last 3 years, RBI was arm twisting banks to provide and classify and all of that. Now for the last 1 year, it's been now resolve, restructure, revive, do all of that. We think India, all ARCs and stressed asset funds put together, can invest about 15 to 20,000 crores easily in stressed assets every year in India. So if it is about 20,000 crore and we can invest about 2.5 to 3,000 crores for us to maintain a 15-20% market share, which is what we are aiming. We currently have a 35% market share, but we are happy with even about 15-20% market share in that. I think this is required because stressed assets is overall 10 lakh crore and what I'm talking about is only about 20,000 crores a year. So I think we will double our assets from current 5,000 crores to 10,000 crores in the next 4 years. And as the leading ARC, as you know, we are the largest ARC in India. We have a lot of skill sets. So we have currently almost 14-15 cases in NCLT where we are working on, and we work on all kinds of restructuring, revival, liquidation, getting in new management, and we have all case studies. And we have actually done fairly well, and that also shows is now the recoveries of the old assets we bought have started coming back. So we are now on the recovery rate of about 2,500 crores a year is the flowbacks are happening. So while we are investing new money, we are also getting money from the old assets back.
All right, so it was pleasure talking to you and thank you once again. And as for you guys, stay tuned into BloombergQuint for more action and news throughout the day.